Hi, everybody. Welcome to DAT's IQ Weekly Market Update. Today's the last show for June, episode 297, June 25th. I'm Dean Croak, market analyst here at DAT Freight and Analytics, along with co-host Chad Kennedy. I'm sitting in for Ken Adamo today, and we're with a special guest today, owner-operator all the way from Texas, Tyler Jones. Tyler, welcome to the show.
Thank you.
Good to have you with us. Whereabouts are you today?
I am in Mount Crawford, Virginia.
Okay. So you're a little bit of ways away from home.
Yes, sir.
Did you come in over the weekend?
Yes, sir. Yes, sir. I deliver a lot of gas station awnings, and they're good. The new Buc-ee's up here, so
Got it.
I delivered 20 columns this morning.
So tell us a bit about yourself. I think you run a flatbed drop deck trailer. Is that right?
I run a 53-foot step deck.
Yep.
I just kind of transitioned over to that in April of last year. I used to run a reefer, and I ran all spot market. And on a whim one day, me and a friend were sitting down talking, and I decided to buy a step deck. So I bought a step deck, and he's in the open deck market. So
yeah, I
kind of followed him around a bit, and I found a contact and got some steady freight out of Texas. So now I do. Yeah. Contract freight out of Texas and spot market back in.
Fantastic. Yeah, Texas is one of our strongest flatbed spot markets by a long way. There's been a lot of strength in the rates down there for quite a few years. Tyler, we'll bring you back in a little bit later on. We'll get to the market update now. Chad, how's things on your end?
Seeing a little bit of increase in spot rates, which I'm sure Tyler will be glad to hear. So I'll report out on some trends we're seeing on the shipper side.
All right. Okay, good deal. Let's jump into our market update. Let's start with some of the key trends we're watching. We're beginning to see the end of this freight cycle that we're in. There's signs that the market is normalizing. June average dry van rates turned year over year positive last Wednesday. That's after 27 months of being in negative territory. That's pretty good news for all of us, having been talking about the trough that we've been in. The market is showing some strength. Some pretty good seasonal trends last week. Van load posts, just over 1 million load posts last week. That's the highest for week 25 back to 2021. Also, the first time reefer spot rates, excluding fuel, have been above $2 a mile since the polar vortex event in January. And on the contract side, Chad's going to talk about what some of the, weakness we're seeing in replacement rates coming into routing guides. The rates are still decreasing, albeit in the single-digit range. The ATA truckload index showed some strength. There's a little bit of life in the index on the contract tonnage side. It was up about 3.6% last month. It's about 1.5% higher year over year. The ATA truckload tonnage index includes LTL freight for clarity, but it is dominated by contract freight with minimal spot market load. So it's up 1.5%. It was the first year over year gain in 15 months. So it's significant. Cash shipments, though, heavily weighted by LTL shipment change. Volumes were down almost 6% year over year in May, according to Tim Denoyer at Act Research, who writes the Cash report. The decrease was partly due to the consolidation of LTL shipments into full truckloads. Housing start data came out last week. Not good news. According to the US Census Bureau, declining multifamily housing starts dragged the numbers down. Housing starts were down 5.5% last month and about 19.3% below this time last year. So most of the decrease in May was multifamily homes. The flatbed freight intensive part of the home construction market, the single family home, those volumes only decreased 2.9% month over month, but they were 5.2% higher than last year. So we're hauling more flatbed loads than this time last year, and many more, almost about 44,000 more flatbed loads were hauled in May compared to May of 2018. So even though the numbers sound bad, we're actually hauling more flatbed loads as higher interest rates put a drag on that market. All right, let's dive into our market update. We'll talk about the load to truck ratio and dry van. There was a surge in load post volumes last week. Again, that's seasonally what we'd expect in the week leading into July 4, which is, of course, next week. Carrier equipment posts were down as there was more volume in the market. So the load to truck ratio was up to 5.01. In the refrigerated market, load post volumes were down last week, down about 6% compared to last year, underlying some of the softness in the reefer market. Compared to non-pandemic years going back to 2017, last week's load post volume was about 3% lower. So we're seeing some softness in the reefer market. Load to truck ratio at 7.84 was the highest we've seen for week 25 going back to 2021. And in flatbed, load posts followed a seasonal pattern. They were down 13% and about 12% lower year over year. The load to truck ratio, though, was at 13.75. That's the lowest load to truck ratio in flatbed we've seen since 2016 for week 25. Having a look at our year-over-year look at spot rates, after being mostly flat for the last 3 weeks, the national average increased by 2 cents a mile last week to $1.77. Remember, these are line haul rates excluding fuel. Compared to last year, spot rates are identical to week 24 last week on a 4% higher volume of loads moved, week 25. So they're identical to this time last year. And on the top 50 lanes, based on the volume of loads moved, they averaged $2.03 per mile last week. That's 26 cents a mile higher than the national average. In the refrigerated market, after running flat for the last 3 weeks, certainly the national average reefer line haul rate was up 3 cents a mile last week, averaging $2.02. That's the first time we've seen rates up since mid-January, above $2 a mile. At that level, rates are about 6 cents a mile lower than last year on almost identical volume of loads moved. And flatbed, lastly, the national average flatbed dropped seasonally, as it does as we get into June and July, down 2 cents a mile last week, averaging $2.06. Flatbed rates are 7 cents a mile lower than last year on an 8% higher volume of loads moved, highlighting the excess capacity that's still in the market. Let's jump into our short-term forecast quickly before we bring Tyler back in. This is our short-term going out 35 days. These are rolling 7-day weighted averages of historical rates of loads moved over 550 miles. So they're excluding fuel, line haul only. The green line is Ratecast. That's our flagship model. Red is the short-term model. For those that haven't seen this before, the short-term model heavily weights more recently seen data, whereas the green line reflects more seasonal, longer-term trends, and the yellow and grey are blends of the two. Let's look at dry van. Over the next 35 days, produce season has an effect on dry van rates as well, not as much as reefer. But Ratecast is showing some disagreement here as we get out into late July. Whereas the short-term model is seeing some stronger seasonal trends. It's looking for about a 4 cent per mile lift through the end of July through 7/27, whereas Ratecast is only seeing a 4 cent per mile lift, essentially going up 4 cents a mile in the next 10 days and then staying flat. I think that's a pretty good reflection of where we see the market. I think the short-term model, as it has been for the last couple of weeks, is a little bit optimistic. So I think Ratecast in green is where I'm seeing the market head. And in produce, we're still not seeing the kind of volume in the produce market we'd normally expect to see as of the third week of June. We're just over a week away from the seasonal July 4 peak in produce volumes and spot rates. According to the USDA data as of last week, volumes are about 11% behind this time last year, and they're 17% lower than the 6-year average for mid-June all the way back to 2016. And compared to 2019, which was a relatively poor year for reefer carriers, last week's volumes are about 20% lower. So we're seeing some real softness in that market. We're expecting rates to drop about 2 cents a mile out to 35 days, but going up 6 cents a mile through next Thursday, which is the peak in produce season shipments, and then falling away. Again, I think Ratecast is seasonally in line with where we think that market's heading. And lastly, in flatbed, Ratecast is expecting rates to continue cooling. A fairly strong model agreement between all 4 models. We're looking for a 4 cent per mile drop out in the next 35 days, which again is seasonally what we normally see once we get past June. All right, so Chad, you've got some news talking about some of the trends we're seeing in the contract shipper market.
Yeah, I'll actually focus on spot rates for shippers this week, but we'll talk a little bit about contracts. So everything that Dean's presented so far has been from a broker to carrier perspective. The load to truck ratio being DAT's load board, which is carrier to broker supply and demand, and broker to carrier spot rate. So we'll transition now over to some shipper rate procurement perspective. So last week I reviewed the shipper procurement mix between spot and contract. Which has not really changed much. So I won't bore you with that slide. We're still around 15% month to date spot mix between spot and contract. So we'll revisit those metrics again in future weeks. The top graph that we're showing here is our shipper spot rate index for dry van. I'll just be showing dry van this week. Temp Control has similar trends right now. And so it's indexed to 2016 contract benchmarks. So the horizontal axis is 2016 to the far left and extends all the way to June 2024 to the right. You can see that the current spot rate trends for shippers have settled since June 2023, bouncing around a little bit there after a steep drop in 2022. And the lower graph is the year-over-year change compared for the graph above. So it's shipper inflation for spot rates. So the news here is that for the first time since June 2020, shipper spot rates have trended from deflation to inflation. So this lines up with exactly what Dean was talking about that we're seeing on that broker to carrier spot rate increase and tightening. So I wanted to show both graphs together because the year over year doesn't tell the whole story. We're starting to compare against a lower base now. Because we're comparing to June 2023, where you see it start to settle down there in the top graph. So the base has now reached a likely bottom, and we're bouncing around that a little bit. So this is all critical for shippers reporting to senior management, while total cost for shippers remains deflationary when you account for the all of the contract procurement, which is somewhere around 85% of procurement. The spot mix and year-over-year spot rate increases, they can represent large risk to a short-term transportation budget for a shipper. So this can also be an early warning sign that the market could flip. That said, everything we're seeing in supply and demand outlook, this is possible that it might be this flattened state for some time. So the future will be interesting, whether or not this will be a tipping point and will continue to increase, or if it'll settle down like it did for 2016 for about a year. So that's a wrap on the shipper side.
Thanks, Chad. This is an interesting setup to bring Tyler back in because there's definitely a sense that we're at the bottom of this market, but we've been at this bottom of the market for quite a few months. In fact, late last year to now, we've kind of been bouncing along the bottom in terms of rate directionality. The rate of decrease of contract rates for your outbound work out of Texas sort of nationally, it looks like it's the rate of decrease is slowing right down. So there's still some downward pressure. But I'm really curious for your return work you do in the spot market. We're seeing spot market rates close to 2019 levels, which wasn't a great year for carriers. But our operating costs to run a truck and trailer are in the order of 20 cents a mile higher than 2019. So we've got much higher costs to run a truck these days in the long haul market. I'm just wondering, how are you seeing this current market? What are you doing to get by in 2024?
I'm just surviving. So I do a lot of deadheading. If it doesn't fit my needs, I go back to Texas because I have contracted freight there. And rather than miss out on that contracted freight, I have to throw a little bit of fuel in the truck and go, go to where my bread and butter is.
Yeah. Are you, when you say go back, you're sort of talking about deadheading back, empty?
Yes, sir.
Yeah, if the rates aren't right.
I've deadheaded back from Montana. I've deadheaded back from, I don't think I'm deadheading back today. I think I have something I found on the board. But, I mean, it eats in your pocket a little, but if you sit for 2 or 3 days waiting on something profitable, that eats in your pocket more than just deadheading back and getting back to what you know.
Interesting. What's your limit? Like, how long do you wait in a market before you turn and burn?
Usually about lunchtime. I mean, if I don't figure it out by lunchtime, I'm cutting into another day. So it doesn't work for everybody. but
Yeah.
for me, I found that it's helped my survival skills.
Tyler, is this every other load or 1 out of 3? What do you have a sense for the ratio that you're going back empty?
Just about every other load because I haul everything out of Texas. And I mean, some of the stuff, sometimes the customer has some shorter stuff that it just doesn't make sense to do a back haul. So you do a shorter load and then turn around and go back and reload. But once it goes out of state, yes, I, I've made some contacts hauling hay back into Texas. But if they don't have any hay, I'll post the truck. I'll look for loads. But in my opinion, the loads that I'm looking at, they're not worth the time it takes to get them back and the profit you make.
Tyler, the loads that you're seeing, are they generally full loads, or are you having to make up more part loads to get a full load?
Oh, they're full loads.
There are full loads.
They're 47, 48,000 pounds.
Right.
And some of them want to be tarp too.
And yeah. And almost for free.
Yes. So again, I mean, when you're running all spot market, in my opinion, when you're running all spot market, you have to find that ace in the hole every time you move. But when you have bread and butter at home, you have to decide, is it worth me sitting here to find a back haul, or do I just need to eat it and go back home, reload, and keep it moving? And that's what I do.
Right.
Tyler, I would think that one of your number one variable costs that you can help control a little bit is fuel. How closely do you watch your miles per gallon, and do you have a target there that you're trying to hit to try to control those costs?
Do I have a target? I like to stay around 7, but the reality of it is when the wind's blowing and you're out west, you're going to get whatever fuel mileage you get. So I try to keep the truck in the sweet spot. For me, it's 1,500 RPM. If I know I'm going home to something that is a dire need and the speed limit's 75, then I'll run 75. But for the most part, I stick around 70. And with an empty deck, I mean, sometimes I can do 8, 8.5. All the conditions have to be right. And if I get a good wind blowing me in the back, I might even be able to do 9. But
right.
And that's another factor in me deadheading back. You know, when I put that 47,000 on the trailer, it's going to cost me more in fuel. So if I'm just doing the load to do a favor and put some fuel in the truck and end up with an extra couple $100, I just say that's not for me.
That's fascinating. Talk a little bit about the equipment for those owner-operators and small carriers out there listening to the show. What are you running? What sort of equipment? What engine, transmission, rears? What's the trailer look like? Give us paint a picture for us.
I have a 2010 Kenworth T660, Cummins ISX in it, 336 rears, 13 speed, 53-foot step with the spread. I can open and close it. I have tarps, but I don't generally carry them because I don't see the money in it right now. Right.
Do you have ramps on the step deck?
I do have ramps. I'm sorry, okay. I missed that point. Yes, I have 8-foot ramps, but I have 4, and then I have the center pieces that can turn them into 16 foot. So if you're hauling something lower and longer, you need 16 foot of ramp so you don't scrape coming up.
Do you? I mean, does your trailer spec avail yourself of the loads that might move on an RGN, like where you've got sort of you need some internal height clearance to get something on a step deck, like a machine, some sort of a heavy machine that might be over-dimensional? Does that ever factor into your backhaul thinking?
I have not done over-dimensional. Again, I picked up this step deck April of last year, so I'm kind of stepping myself into it. I just, in my opinion, there's guys out there that have a lot of experience in over-dimensional. And if you come into something that you have no experience in, you begin to mess with the rates. And it can be a danger to the public too.
There's the liability angle. It's a lot of time daylight travel only. So that again impacts your head haul back out of Texas, right? Is the timing aspect of this.
Yes.
Yeah. Have you, Texas is a really hot market for us in flatbed. Have you ever done any work out to the Permian Basin, out to Lubbock? Do you get out that way?
I've gone to Amarillo. Matter of fact, I just went to Amarillo last week with customer freight. But as far as on the board, and that was another one of those deals where there were multiple loads going out there, and we took it to Amarillo and come back. So I didn't get a chance to look at the spot market.
Right. Yeah. I'm just curious about the carriers that run out to that market have the same mentality, like in terms of running back empty, or do they? It sounds like it's a market that's not a lot of freight coming back out of there. Is that correct?
I would say that, but as far as what each carrier does, I think, I've been in a truck for, it'll be 18 years in November now. I think everybody has their own way of looking at things, and some things cause people to fail in this industry, and some things others haven't figured out yet that someone's maybe doing that. Like one of the phrases I hate when dealing with just any particular broker is when they say, well, it'll pay you fuel. Well, no one's in the business of paying fuel. And that's something I've heard a lot of older drivers say. Well, it pays my fuel. Well, that's a statement I don't agree with. We don't need to pay fuel. We need to make a profit. We need to make money.
Tyler, when you run your contract rates, are you doing that directly with the shipper or through a broker?
It is actually through a parent carrier.
Okay.
And the customer's well aware of it. There's several different small carriers involved in it. And
okay.
So basically, one phone call is made. We give up a small percentage, 5%, which no biggie, because I mean the main carrier's done all the legwork, but we're like a family.
Right.
And when you negotiate those longer term contract rates, is there a fuel surcharge program, I assume, in those rates?
There is a fuel surcharge. However, the parent carrier does all the negotiating, and then we just get paid in.
Sure. Okay, that makes sense.
Tyler, what are the top three things you watch in terms of your operating costs? Obviously, fuel's one of them. What else do you watch that can make a big difference if you're not on top of it?
I feel like fuel, time is not a cost, but just time can get away from you.
Time.
Maintenance can make or break you. Really, for me, it's just fuel and maintenance. I mean, if you can do some of the stuff at home, like greasing your truck, if you got the resources and the capabilities of changing your own oil,
yep,
that can do a lot for you.
Yeah,
and it's easy. Something as easy as purchasing your oil. $28.99 for a gallon of oil in the truck stop. You can go to Walmart and get it for $12, $14.
Right. Yeah, it's much cheaper to do it yourself. That's for sure. How do you manage your profit and loss? Do you have an accountant, someone that does sort of a trial balance each month, or do you use QuickBooks? How do you manage your costs?
So me and my wife do it. We have built a spreadsheet, and it just comes from trial and error. You go through things and you say, man, I wish I knew this number. I wish I knew that number. So we're just continuously editing our spreadsheet. We just use Google Sheets, and we have a spreadsheet, and everything I do, she plugs it in. I wash the truck, she plugs it in. I wash. I fuel. I have a part I need to buy. She plugs that all in, and it shows us our numbers, and it helps us to know, hey, we need to stop doing this, or we need to start doing that, or we need to pay more attention to whatever area.
When it comes to eating on the road, are you a master chef, or do you buy from the
I'm horrible. I buy everything. McDonald's, Wendy's, Taco Bell. I don't do a whole lot of sit downs. I do some sit downs, but I'm horrible when it comes to eating. I'm actually running with another guy right now, and he's got a refrigerator in his truck, and I was telling him I really need to just put a refrigerator in the truck.
Yeah.
I mean, the whole time I've been out here, I'm just always which I don't eat, but if I eat twice a day, I'm doing good. I might eat once a day, and I don't starve myself. I don't do a lot of stopping. I try to make my time matter.
Yeah. Refrigerator would be a good start. Maybe a pull-out barbecue deck under the trailer might be a good addition.
I mean, it probably would. I'm going to tell you the problem with the refrigerator is I put a 12-inch subwoofer in here, and it's in the spot where the refrigerator goes, and I don't want the refrigerator in another spot. So I'm have to get rid of the subwoofer.
So you're happy, but not eating as well as you could. That's the main thing.
Right.
That's funny. So you said you've been at this for 18 years. Was that right?
It'll be 18 in November.
So one of the questions I'd like to ask is, knowing what you know now, what would you tell a Tyler Jones starting out 18 years ago? What would you say today?
Keep the Freightliner I had.
Right.
Take some more, take more risk, because I operate in a safe zone too much, and when I talk to people, I tell them all the time, Snyder, Warner, JB Hunt, Swift, they took that risk to get that big. Right. So if you stay in your safe zone, time's going to run out. Yeah. But I mean, I just had to have a Kenworth. I thought that was just
right
the thing to do. But I had a Freightliner Century. It was an old JB Hunt truck, and it was running good. My mechanics were like, "Man, this is a good truck." I said, "Well, I'm 900 and something thousand, and I'm not ready to rebuild it, so I'm just going to go buy another one." And they were like, "You don't need to rebuild it.
Right.
We've done the lower end.
Right.
Matter of fact, if you want to rebuild it, just let us rebuild it and we'll finance it." And I said, "No, I'm just going to get another truck." And I missed that truck.
Yeah. It's Series 60?
It was a Series 60. It was a 12.7 Series 60.
Yeah.
And I feel like a Series 60 is indestructible. I mean, they sweat oil. Like,
yeah.
It's only a matter of time. I mean, you can keep fixing oil leaks, but it's only a matter of time, in my opinion, until they start sweating oil.
Yeah.
And then, I mean, you just keep it on the dipstick and it's going to run.
Yeah. Fascinating advice. So in take more risks in the spot market side, what would take more risks look like?
See how I can see that in the spot market side. Just like where you think you want to go, take that load you wouldn't actually take.
Okay.
And see where it gets you.
Right.
Operating in the safe zone, thinking not know everything, but I know that market. I'm not going there. I mean, in 17, almost 18 years I've been doing this, I can tell you 2 markets that still haven't changed, but I've gone to markets that I said, "Oh, I'll never operate out of here," and then I've made some of the best contacts coming out of it.
Right. Yeah, that's good advice. Running different lanes. Part of experience comes from poor judgment. So sometimes we've got to make a lot of bad decisions to figure stuff out. So there's nothing wrong with taking those risks. But I like your thinking in terms of, you get to midday in this current freight market, you have a sense that if it's not happening by midday, it's not going to happen. Is that pretty much how this current market works?
Oh yeah, I mean that's the way I've always operated.
Right.
I've found that works for me. If I post a truck and my phone begins to ring about 7 or 8 a.m., I got a pretty good idea I'm in a good market, and I can pick what I want.
Right.
But if it's 10 a.m. and my phone hasn't rang at all, I might need to make a selection, or I'm going to be deadheaded.
Chad, I'm kind of hogging the microphone here, but one last question. What advice would you give brokers that you talk to every day? What's your best advice for them?
All drivers aren't the same. I mean, and I mean, really, it sounds horrible, but get off the queue. And when I say the queue, like a lot of things, some of the major brokerages you talk to, you can tell it comes from training. I will do a load that I wouldn't normally do just off of the relationship. It doesn't, the money matters, but I will do a load for a couple $100 cheaper, just having a respectful phone call. But when it gets nasty, now I feel like I have to earn, not earn my money, but I feel like, oh yeah, let me get my money. Like, if I have to deal with this, let me get my money. And I've walked away from bad attitudes. And it's not all brokers, it's not all brokerages, but I'm not gonna say any names, but there's a major brokerage out there, and you can tell they go through a type of training that it comes off as very cocky when you're on the phone. I'm 39, and I find that people my age and maybe even younger, they come off like, I'm live, so I don't really want to say this, but I'm not going to sugarcoat it. They come off like the old school term used car salesman,
Right.
And no one wants to deal with that. I mean, if in this industry, amongst drivers, amongst the industry, if you got a good attitude and you're a good individual, people want to help you. And I don't see that ever changing. But if you have a bad attitude, people will leave you stranded.
Great conversation, Chad. Anything else you want to fire off?
Yeah, same question for shippers. I know a lot of shippers are focusing on trying to be a shipper of choice, and they know that that goes all the way down to the driver. What advice would you give to shippers to make their facilities more attractive to drivers?
This is way out there, but what I would like to see is, if you know you're going to receive 30 loads in a workday's time, have the room to accommodate 30 trucks.
Right.
Because a lot of people want you to load or unload and get off their property. And that to me, everybody needs their stuff delivered, but I don't need special treatment. But like Mount Crawford, where I'm at now, it's kind of dead. I'm sitting in a truck stop that has 15 spaces, but right behind me is a Walmart distribution center at the end of this road. There is not enough room for these guys that might have a 4 a.m. appointment to park at this truck stop and make their 4 a.m. appointment and get back somewhere else on the e-log. And some people say, well, use, yard move, use personal conveyance. Everybody doesn't want to do that. So in my opinion, if you're set up to receive a certain amount of trucks, be set up to have a staging area to where you can accommodate their DOT break.
Yeah,
that's great advice. Yeah. All right, Tyler, thank you so much. It's been a fascinating conversation. We're right up on time. A couple of shout outs. Chris, in fact, Chad Kennedy, our very own Chad Kennedy, is going to be on the Freight Vine podcast with Professor Chris Kaplis. That's released on Thursday. I'll be on Radio Nemo with Jimmy Mack on Thursday morning, 8 a.m. on Road Dog Radio. That's channel 146. Don't forget DATCon's coming up in Kansas City, October 22 to 24. Early bird registrations open at dat.com/DATCon. Next week, we've got Dustin Jalbert from Fast Markets talking about the lumber industry and the latest trends in building. Tyler, before we go, if people want to contact you and get some advice, how would they go about doing that?
You can reach me on my email, and it's tjonestruck@gmail.com.
Okay.
I'm on Facebook. I'm on Instagram. And I think I said it right. I can send out my information to you guys as well.
Okay. Please do. Yeah. All right. We'll make sure we get those contact details into the link in the show. With that, another show is in the books. Thanks for watching, everybody. Be safe. Be nice to everyone out there. And we'll see you again next week at 10 a.m. Eastern, 7 a.m. Pacific.